Good day, everyone. In this lecture, we're going to discuss fraud, error, and non-compliance with laws and regulations. And this is Attorney Vanessa F. Tamaray, your lecturer for this session. And this lecture is prepared for UST AMV College of Accountancy in the course CA51022 in collaboration with Mr. Berbano, Dr. Ligan, Ms. Matula, Mr. Toribio, and Mr. Yabut. Our weekly expectations are we will discuss fraud and error, the fraud, the meaning of fraud, the fraud triangle, kinds of fraud, and the 2020 report on the nations by Association of Certified Fraud Examiners, or ACFE. We will also discuss error, the meaning of error, and how is it distinguished from fraud. Next would be, we will be discussing the accountant's professional and ethical responsibility against fraud and error. And with that, we will tackle one by one the professional standards and code of ethics of different accounting professions, such as Philippine Standards of Auditing, Standards for Internal Auditors, the Code of Ethics for Certified Management Accountants, the Philippine Government Internal Audit Manual, and the Information System Audit and Control Association Code of Ethics. We will also discuss the SEC rules, or the Securities and Exchange Commission rules, with respect to fraud and error. We will also discuss the Financial Reporting Bulletin number 19, which requires the professionals act on fraud or error, particularly the certified public accountants who are in the practice of auditing, and Securities and Exchange Commission Memorandum number 13-06. Now, for the non-compliance with laws, we will discuss the non-compliance per Code of Ethics, the Accountancy Code of Ethics in the Philippines, and we will also discuss administrative penalties, civil penalties, and criminal penalties with respect to non-compliance with laws and regulations. And we will have a special lecture on Supreme Court decided cases and SEC opinions with respect to accountants who were punished or penalized due to fraud, error, and non-compliance with law. Now, what is fraud and error? And what is the relevance of this fraud and error in the accounting profession? Misstatements in the financial statements can arise from either fraud or error. That is why it is very relevant for us to discuss what is fraud and error. And an accountant, as a professional, has certain responsibilities with regard to this fraud and error. The relevance of this is that we will know when would this fraud and error occur, and what are the responsibilities of the accountant should this occur in order to revert the error that has happened, or to prevent or to report the fraud that has happened. Fraud. Fraud is an intentional act or omission designed to deceive others, resulting in the victim suffering a loss and or the perpetrator achieving a gain. So this is a definition issued by Commission of Sponsoring Organizations of the Treadway Commission, or the COSO. Now, if you're going to take a look, fraud says that it is an intentional act or omission. So here in fraud, this is not a mere inadvertence. This is a deliberate and intentional act. With all volition, the perpetrator committed this act. And this act has the purpose to deceive others. So that's why it is very obnoxious, or it is disgusted by many, and it has negative effects because the purpose is to deceive others. And the result of which is that the victim will suffer a loss, and the perpetrator in return will achieve a gain. So that is fraud. How about the definition by Institute of Internal Auditors? It says here that fraud is any illegal act characterized by deceit, concealment, or violation of trust. These acts are not dependent upon the threat of violence or physical force. Frauds are perpetrated by parties and organizations to obtain money, property, or services, to avoid payment or loss of services, or to secure personal or business advantage. So if we're going to take a look again at the definition, we will see that it is any illegal act, any unlawful act characterized by deceit, concealment, or violation of trust. There is the word deceit and concealment. And in the perpetration of fraud, the violence or threat of violence or physical force is not a material element. It is not an essential element. Fraud may be committed even without the use of threat or use of violence or physical force. Most of the time, fraud is committed surreptitiously or clandestinely in order to avoid them from being caught. So most of the time, there is no threat or violence. Threat of violence or physical force. And it says here that frauds are perpetrated by parties and organizations to obtain money, property, or services. So remember what we have said a while ago. There is that intent on the party perpetrating the fraud to gain. There must be that gain. How about the fraud as defined by the SEC or the Securities and Exchange Commission, Rule 68 and SEC Memorandum Number 13-03? It says that fraud means an intentional act by one or more individuals among management, employees, those charged with governance, or third parties involving the use of deception to obtain an unjust or illegal advantage that results in a misrepresentation of financial statements, which has the result of reduction or increase in the related accounts by 10% or more. For issuers of securities to the public and public companies, as defined by SEC, the test shall be 5%. So later we will discuss what are the acts that involve fraud. But here in this definition, it says that there is an intentional act. Again, this is not mere inadvertence, mere mistake, but when we say fraud, it is a deliberate act, overt act by the perpetrator. And when you say fraud, it may be committed by the management, by the employees, or those charged with governance, or even those persons who are not within the organization. So it may be committed by any person as long as there is an opportunity to commit the said act. And here in the SEC definition, as you could notice, there is a 10% and 5% threshold. Why is that so? Here in SEC, the SEC recognizes the materiality rule. Since in the SEC, there is a mandate on the professionals, particularly the accountants or auditors, to report the matter at hand, or that if they do not perform that reportorial requirement, they will be penalized. Then the SEC made it necessary to have the threshold so that those fraudulent acts that do not that did not fall within the threshold will no longer or does not is not mandated to be reported by the auditor or the persons who are responsible to report the fraud. That is why there is a threshold, because not all fraud are reported, only those which are material to the entity or to the business. And for non-public companies, we have a 10% threshold, and for the public companies, there is a lower threshold, 5%. And when you say material, it means that this amount or this reduction or increase in the assets, liabilities, or equities of the company would affect their decision making with respect to the economic decisions. So, kaya meron tayong sinasabi na threshold because those which do not fall within the threshold are not mandated to be reported. But it does not mean that they are not fraud per se. Of course, they are still fraud. But what SEC wants to have is that only the fraud that falls within the threshold would be reported or would be subject to penalty based on the materiality threshold. So I mean the fraud that has an effect of increase or decrease in the related accounts equivalent to 10% or 5% for public companies would be reported or mandated to be reported by the responsible officers. But it doesn't mean that those that did not fall within the threshold are not fraud. They are still fraud, except that there is no responsibility or there is no mandate to report the said fraud. Now, what are the acts that may involve fraud? Letter A, we have manipulation, falsification, or alteration of accounting records or supporting documentation from which the financial statements are prepared. We also have misappropriation of assets. We also have suppression or omission of the effects of transactions from records or documents, recording of transactions without substance, intentional misapplication of accounting principle relating to amounts, classification, manner of presentation or disclosure. We also have misrepresentation in or intentional omission from the financial statements of events, transactions, or other significant information, collusion, forgery, or override of internal controls. So we have here manipulation, falsification, or alteration of accounting records or supporting documentations from which the financial statements are prepared. It means that fraud is not committed on the financial statement level only when there is already the preparation of financial statements. It may be committed even at the very outset, such as at the level of the supporting documents. So it means that sometimes fraud may be committed by the persons or the perpetrators in order to alter the accounting records or supporting documentation with the inevitable effect of affecting the financial statements. So it starts from the very beginning. Because remember, when we say financial statements, this is already, or these are the summary of all the accounting transactions. And if there's fraud in the transactions in the very beginning, then the financial statements will be already misstated. And we also have misappropriation of assets. If not in the fraudulent reporting, if the fraud is not committed through fraudulent financial reporting, Fraud may also be committed by misappropriation of assets. What are the examples? Embezzlement of funds, the unlawful taking of the assets, and etc. So we also have here suppression or omission of the effects of transactions from records or documents. So this may be related to non-recording or double recording or omission of transactions. Then recording of transactions without substance, such as bogus reporting, or there has been really no transaction, but it was made appear they made it appear that the transaction has occurred. So kanina, meron tayong omission. There was a transaction, but it was not recorded in order for the funds to be embezzled, or in order for the financial statements to be fraudulently reported. And here, we also have a transaction which was recorded but without substance. Next, intentional misapplication of accounting policies or principles relating to amounts, classification, manner of presentation, or disclosure. Then misrepresentation in or intentional omission from the financial statements of events, transactions, or other significant information. So there is a misrepresentation that there is for example, this transaction occurred, but it was presented in such a manner that it purported another thing. So it no longer represented or presented faithfully the real transaction. And also collusion. When you say collusion, that is a conspiracy with other people in order to commit the fraud. And forgery, that is alteration or using another's signature or falsification of a document in order to commit fraud or to falsely present a document. And then override of internal controls, which means that there are internal controls, but they make it to a point that these controls are not followed in order to accomplish their fraudulent intent.